Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our Frac Spread show. I'm going to talk about what's happening with U.S. activity, where things are sitting right now, touch on kind of where some of these flows are going, because we're seeing some different shifts in terms of where oil is heading. Obviously, Urals is a big piece of that. Then we're going to touch on a little bit on the econ side, just because we did have the U.S. GDP numbers come out. We want to talk about kind of where things are shifting and as we head into quantitative tightening. So as we go through that, the crude price is clearly at 105 and falling, but it's still obviously over 100. So it's not surprising to see that we have activity grinding back up. So we had an increase of 2. We went from 271 to 273. Again, it's more of a steady grind now. We've had several things come out. At this point, we've had Chevron, which just came and will produce at least 15% more from the Permian Basin this year compared with 2021 for a total output of about 750,000 barrels of oil daily. So again, we're starting to see that shift. The Permian was still above 150, but came down a bit. Some of the increases were in the areas that we've been discussing, where some of the smaller basins and then in the other, which is what we define, and something extra that Primary Vision offers versus what is out there in the market and what the EIA has. We kind of aggregate some of these other counties just because it's important, because some of them are also very heavy in dry gas. And that is going to be a big push, especially when you start looking at where LNG prices are, where the gas market sits. We have Henry Hub at $7.30. We have floating LNG flying off the shelf. So again, there's a lot of reasons to kind of backstop into that, which is why I think that's a really important one. Another key piece are refracs. And I know that there's a lot of, back and forth on refracs, recompletions, but regardless the nomenclature, we're looking at something that we think there's a lot of opportunity, especially in areas of the Haynesville and the Eagle Ford. And we do have a report coming out on that in terms of what are some of the recent findings, what are some of the production flows, and where we think there's a lot of opportunity for additional capacity. And again, all of this is a matter of bringing back some of that capacity, bringing back some of that production, especially given where prices are. And then when you do refracs, obviously there's a lot of variations, but you also can increase your liquids and natural gas cut. And given where some of this pricing is, it makes a lot of sense. Now, while spreads continue to grind higher, so did rigs. The horizontal added another 4. Directional fell by 1. But again, the horizontal continues to be the big driving force. We continue to see those moves going forward and that expansion. So when we look at some of the different pieces, especially when we look at where they're being added, I'm just pulling up that data here. So here, when we look at where the additions, we had New Mexico, Louisiana. Obviously, very much focused in what we've been talking about on the Louisiana front, natural gas. On the New Mexico side, the Permian, or I should say the Delaware, when we're looking at some of the different flows. So now when we start looking at the China supertanker crude imports, this is something that we wanted to really look at and talk about when we're looking at some of the different opportunities in these different flows. So on the China supertanker crude imports, you can see that we had a bit of a drop, still elevated for where it is. But this is what we were discussing on the EIA show. You're going to have, this number is going to ebb and flow because they still have their lockdowns, they still have their problems. So how much of this is going to get resold? How much of this is going to go into a slow steaming? And then when you look at the observed flows, so when we talk about Urals crude from the 3 main Russian Western ports to Asia surged to the highest in almost 4 years. But Europe still remained one of the top destinations. So Asia will receive about at least 3.48 million tons of Urals for April loading, just to give you an idea of where we sit. The highest since at least October of 2018, going higher as well. India will receive at least 2.28 million tons, the highest since October 2018 as well. China will receive at least 400,000 tons, again, different movements, but Europe will receive 3.995 million tons of Urals for April, representing about 43% of total Urals seaborne exports. And that compares with about 85% for the whole of February. So again, you're still seeing that drop still in there. Now, as we said, the tankers, 97 super tankers to China, down from 110. Some of them have also shown up. They're now in floating storage. Some of them, they get resold. So again, that's where some of these movements are. 29 vessels are headed for the U.S., up by 2. So that's the highest this year. So again, that's more also seasonality, because typically we see a bigger increase in imports as more activity happens at the refining front. Now, speaking on the refining front, what happened in Singapore is kind of in line with what we were discussing, where light distillates continued to see that slight build. Middle distillates back down, still very bullish. A lot of that flow from Asia is coming into Europe. So instead of going into Singapore for storage, we're seeing it kick right back out into Europe. Residual fuel, have some of that lumpiness. Some of it's getting recracked. Some of it's being sold because the heavy disty resid is replacing some of that the middle distillate, given just how low and how strong those prices are, with a surge in diesel prices again in the U.S. On the European front, you can see there was a small drop in gasoline, still a record high of gasoline. We expect that to accelerate a bit as some of those exports increase. And then some small builds across the board, with gas oil being one of them, but still obviously in a very bullish spot. And it's now, the one thing I should say is it's not only coming from Europe, from Asia into Europe, but also from the Middle East, with a huge surge in flow coming, obviously from the Middle East on the disty side and gas oil side into Europe. Now, some of the fun things when we look at what is happening on the RRP, which is the opportunity for banks to place liquidity, excess liquidity with the Fed in the overnight window. Here you can see that we, coming into month end, you always kind of get a surge. Month end, quarter end, year end is typically when you get this big spike. So we were just under $1.91 trillion. So to give you an idea of the amount of excess that's still sloshing around. Now, it's funny because you have the mortgage rates going to 5.5%. You already have the 10-year going up. You have the yield curve steepening. You have yields going up across the board. And yet we still have $1.9 trillion just sloshing around the system. So again, the tightening is going to happen. It's just how bad is this going to get as the tightening increases, as this comes through, or is this now priced in? And what we're seeing here is pricing in the fact that we're going to go from 1.9 back to maybe something that is more normal of sub 500 billion. But again, we're just talking about the sheer size and the amount of liquidity sloshing around in the system. Now, as we start talking about what's happening in China and how this factors into what is occurring in the U.S., we want to look at world delivery times, because the U.S. had gotten better. And now, as we talked about in the Econ show, and we're going to talk about again next week in the Econ show, we're starting to see the supply delivery times extend again. And the problem is it's only going to get worse as we progress through May and really kind of hitting that peak in June, because you have to think about sailing time. We have China that's been in a lockdown, especially on the coastal points, but it takes time because there were already ships that were en route. They were already sailing. There was a backlog on the West Coast. So again, there's stuff to work through. So again, as that starts to show up, that's only going to get worse. And we're going to have more of that supply side price push, which again is going to just provide that tailwind for the inflationary movement. Here's just an example, just an update from what we talked about on the EIA show. You can see that as we get to week 19, you see that huge drop in TEU volumes. We expect that to continue and really kind of hit this floor as we go through June. But just given on timing, how quickly China gets back, when they get back, we see this actually progressing through the summer, which if you think about when people do the most, spend the most, typically the summer months are that period. So again, that's just even more of that supply side shortage, which is going to create that pricing pressure on top of your typical summer demand. That's again going to drive pricing higher. This is something from FreightWaves that just looks at the ocean TEU volume index. So it's all ports from China heading to all ports in America. So again, if you think about 6-12 week, depending on timing, 6-12 weeks, coming from Asia to the U.S., you're getting an idea of just how things have continued to come and step down. And this is all the way out to May 12th to give you an idea of why we have that confidence that we're going to see this progress well into the summer months. Some things are picking up when you look at road freight. So again, they're trying to bring things through, as we talked about. I think it was 2 or 3 weeks ago on the Econ show. There's a movement of trying to get these roadblocks away, trying to move things through, get things back active. But again, you're still seeing that there's a lot of work to be done and a huge backlog. So when you look at China's nationwide supply chain disruptions seem to be marginally improving, which is good news, but the prospect remains uncertain depending on whether there will be more COVID-19 outbreaks, and we think there will be. Now shifting to the U.S. and some activity, the return to the office has been obviously slow. There's a mixture, as we've been talking about, of the hybrid movement. So here you can see that on average, we're about 18 to 20% below normal on people in the office. And that's just, as we've been saying, that's something that we think is going to be fairly stable through the remainder of our lifetimes. I don't know. When you look at just kind of that new paradigm shift, and now given, I don't think permanent work from home is the thing, but I do think there is more and more of this adoption of the hybrid workplace. Now just kind of looking at the product shortage indicators. And it's, to be clear, this is before what happened in China. So that's why we wanted to look at that caveat as we go forward, because now we're going to start talking about why the GDP number was so bad and what really drove that. And I should say so weak, given the fact that it was negative growth. And when you look at the shortage side, you can see that the U.S. had improved a bit, still obviously at near all-time highs. But other places are getting worse. And now that you're seeing those issues that we've seen coming out of China, that's only going to pivot. So we've already seen the pivot in the U.S. of product shortages getting worse, and that's only expanding throughout the world. And we're an importing nation. So first, now when you turn to U.S. personal consumption, here you can see that the expenditures, the core price was at 5.2%. And then when you chain that, it was at 6.6%. So it had a little bit of a pause, which is a positive. And if you look at, obviously we're back at 1980 levels. But when you look at that pause, now you have a little bit of that demand push, as we've been talking about. You're going to get, and then obviously the supply side. The supply side is getting short again, which is going to pump that up. When we talk in the Econ show, we're going to look at employment cost. Employment cost is at record highs. That factors into cost. And when you're looking at companies trying to catch that up, and then as we looked at those leading indicators in the Econ show this past week, we saw the big increase in prices paid, and with some of the new data that we'll talk about next week also showing the same. Now, when we look at real U.S. GDP, it was negative 1.4% in the first quarter, and there are two key pieces with that. One, the federal government. We've been talking about the government transfers as a percentage of disposable income continues to fall. And this is that fiscal drag that we've been talking about, where the government has already spent a lot, and now you're going to see that come out. Imports exploded, and that's what we were covering month by month. We kept setting a record for the amount of imports we're bringing in because we had a shortfall, because the U.S. is the largest importing nation in the world. Now, that's something that is going to adjust a bit because you have some of those pivots, but the other, some of the pivots with China, and we're just going to get a natural kind of slowdown in imports, which should be a little bit of a benefit when you think about how GDP is created. But then the other key piece is on the inventory side. So as we said last quarter, inventories are very lumpy, and inventories was a huge driver of the Q4 beat. As you look at the at that yellow bar on the left chart. But then when you pivot into this quarter, inventory was actually a negative. And that's something where, because you had, the inventory was drawn down a bit, that's where you're going to start to see that come through because it's very lumpy. And as retail sales continue to kind of be fairly lackluster, we are going to get a drop in imports. So that's going to eat into some of the inventory, kind of beginning some of that drag. And then the other one is when you zoom in on the trade balance, there's where you can see what we've been discussing. It obviously ebbs and flows given what we're bringing in, how much we're bringing in, and given the issues that we have in China, you can expect that import number to not be as big, but it's still going to be a net negative, if you will. And here's just an example of just of just how bad that number really is when you start looking at it as an aggregate. So obviously, that's something that will, as that kind of adjusts, it'll be a little bit of a benefit from the GDP perspective. But consumer spending is going to remain a headwind. You're going to have the federal government and just the fiscal transfers. That's going to continue to slow. And then when you start looking at what is happening on the inventory, that will continue to be a bit of an overhang when you look at how the math is done. So we don't expect to see negative growth in Q2. Obviously, that's something. It's just we don't expect to see a lot of growth. It's just going to be more of this kind of bumping along of slightly positive. I don't think slightly negative. And then I think the pressure really starts to mount as we get into Q3. So that's what we have for you today. If you have any questions, please reach out to us on the comment section. You can find me on Twitter as always. And we hope you have a great weekend. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.